Today on Real Estate Backstage, Keller Williams takes on outside investment capital for the very first time. The United States Treasury Department announces that it will not be enforcing the BOI reporting requirements of the Corporate Transparency Act. The Ninth Circuit Court of Appeals sides with Zillow over Rex and the DOJ. Some of Trump's tariffs go into effect while others are delayed. And finally, the most recent data we have on the labor market presents a bit of a mixed bag. Before we jump into today's conversation, if you're watching on YouTube or if you're listening on Apple Podcasts or Spotify, go ahead and subscribe to the channel. That way you don't miss any future episodes. And if you're looking for the show notes where you can find links to all the articles that we referenced today, you can find that at realestatebackstage.com/episode 21. Now, if this is your first time watching or listening, I'm your host, Michael Smith. I'm the CEO and broker in charge here at Bluefield Realty Group. We are a 3-time Inc. 5000 company headquartered here in Greenville, South Carolina, and we provide real estate brokerage, property management, and insurance services. All right, so we're going to jump in today. We're going to get started with this news about Keller Williams, and this is according to Inman. Quote, Keller Williams will sell an investment stake in its 42-year-old company to Stone Point Capital. Amid news of the historic sale, Chris Czarnecki, the former CEO of Broadstone Net Lease, a real estate investment trust, was named to replace Mark Willis as Keller Williams' chief executive officer, a position that has been vacant since late January. Co-founder Gary Keller will remain in his role as executive chairman of the company. This is an exciting milestone for all Keller Williams agents and franchisees, Gary Keller said in a statement. We've built an incredible foundation, and as we focus on each agent's personal development and their continual sales growth, we welcome the partnership and backing from the team at Stone Point Capital. Terms of the deal, including the precise ownership stake Stone Point is taking, were not made public. A spokesperson told Inman that Keller Williams will be owned by Gary Keller, Stone Point Capital, and other members of the company's leadership team. Czarnecki will also be co-investing alongside Stone Point, the spokesperson said, unquote. So Keller Williams is a privately held company that has never before taken on outside investment capital in its 42-year history as a company. Stone Point Capital is a Connecticut-based private equity firm. They've invested in other real estate companies that you might recognize, such as CoreLogic, Lone Wolf Technology, and Rialto. The official statement from Keller Williams says that the purpose of the capital infusion is to drive continued growth and innovation. However, at the very same time that this deal was announced, they brought in a new CEO, Chris Czarnecki, and he has experience with IPOs. So, there's been rumors floating around for many years now that Keller Williams has been preparing to go public through an initial public offering. However, they have not confirmed or denied that news. It is possible that Keller Williams maybe feels like they're beginning to lag behind some of their publicly traded competitors. So, for example, Compass, Redfin, EXP, Real, and others, they all saw rather accelerated growth after their IPOs. So it could be that KW is starting to feel a little bit left behind, and a lot of these other companies are growing faster. So this is something maybe they feel like they need to do in order to continue to innovate their technology and do some things to try and attract and retain agent talent so they can keep up with the competition. That's one way to look at it. Another take is that, Gary Keller is going to be turning 68 this year, not a spring chicken. It could just be that he's ready to take some of his chips off the table and diversify his net worth away from Keller Williams and into other things. It's rumored, estimated that Keller Williams as a company is valued anywhere between $1 and $2 billion. Nobody really knows for sure because, again, it's a privately held company. They don't do earnings reports. They don't really make any of that information public. But all the best estimates out there from industry insiders seem to think somewhere in the $1 to $2 billion range. Now, if you started a company and it was privately held, closely held, you have a majority ownership in that company. And over several decades, it gets to the point where it's worth $1-2 billion. If you don't sell some of your stock, if you don't find a way to cash out and liquidate, the vast, vast majority of your net worth is tied up in that company. And that's probably the situation that Gary Keller finds himself in. So this could be maybe a combination of the two things. Maybe he wants to bring in that outside capital rather than taking on debt to fuel additional innovation and growth, maybe make some acquisitions, and combine that maybe with the fact that Gary Keller just has so much of his net worth tied up in Keller Williams, and he wants to, cash out a little bit, take some of his chips off the table, and diversify his net worth into other things. That would make total and complete sense. Would not knock Gary Keller for that at all. Smart business move. All right, so speaking of mergers and acquisitions, CoStar Group closed a $1.6 billion acquisition of Matterport. This is also according to Inman. Quote, nearly a year after announcing its acquisition of spatial mapping company Matterport, Virginia-based portal CoStar Group has completed the $1.6 billion deal. CoStar Group and Matterport have long shared a vision of digitizing the real estate industry, and today we officially unite to realize that future together. CoStar founder and CEO Andy Florence said in a written statement. Matterport's cutting-edge 3D capture and AI-powered property insights have already transformed how residential and commercial properties are marketed and experienced. By integrating Matterport's groundbreaking digital twin technology with our vast property data and online marketplaces, we're creating an unparalleled solution for buyers, sellers, and renters to explore properties with greater depth and insight than ever before, he said. The Matterport acquisition has been a key part of CoStar's earnings outlook for the past year, as the company plans to leverage Matterport's 3D interactive floor plans to bolster the Homes.com search experience. In CoStar's third quarter earnings, Florence said integrating Matterport technology was a key part of bringing Homes.com out of a membership growth plateau alongside hiring a larger dedicated sales team, unquote. So we all know CoStar Group, they acquired Homes.com within the last several years. They made a big marketing push. I don't think it's possible to be a real estate agent in America today and not have received all kinds of marketing from Homes.com. You know, they've done Super Bowl ads the last couple of years. They did a just incredible direct mail campaign. I think every single real estate in the country probably received several dozen pieces of mail from Homes.com when they first made this push a little over a year ago. And they've also invested a lot of money into hiring salespeople to call real estate agents and pitch them on signing up for a paid membership of Homes.com. So Homes.com is a search portal similar to Zillow, Trulia, Realtor.com, etc. Their big differentiator is that they don't sell leads to real estate agents. So when a consumer goes on Homes.com, they find a property they like, they click the button. That inquiry is sent for free to the listing agent of that property. So instead of making their money by selling leads, they sell ad space to agents. So you can become a featured agent. You can boost the presence of your listings on the portal and things like that. So this is a big acquisition, $1.6 billion. Matterport, of course, is a great technology. It was groundbreaking. There have since been other similar companies that provide a similar product to what Matterport offers. But this is good news for CoStar, especially if you happen to own stock. All right, let's shift gears a little bit here. So the Treasury Department plans to not enforce the BOI reporting rule. This whole story has just been a complete mess. We talked about this last week as well. Just for context, if you haven't been keeping up with the story. So the Corporate Transparency Act was passed by Congress a couple years ago, went into effect January 1st of last year. Originally, if you had ownership interest in a private company, like an LLC, something that's not publicly traded, you had a certain amount of time to file a beneficial ownership information report to the federal government, FinCEN, which is part of the Treasury Department, claiming and disclosing your interest in this private company. Now, litigation was brought against the law. Many claimed it was overreach and unconstitutional. Originally, there was an injunction put in place to stop the rules from going into effect. That injunction was removed by a different judge. Then the injunction was put back into place, and then the injunction was removed again. But now we have the Treasury Department saying they're not going to actually enforce the rules. So it has been very difficult to keep up with the latest. I have our agents here at Bluefield Realty Group reaching out to me all the time asking, what's the latest? Do I need to file this report? Do I not need to file it? As of right now, the way things stand at the time I'm recording this, which is Friday, March 7th, 2025, and this could change by this afternoon. But as of right now, here's where we stand. The injunction was removed, so the law is in effect, and the deadline had previously been set at March 21st to file those reports. So as of right now, the law is in effect, and that law was passed by Congress and signed by President Joe Biden back in 2022. So that is the law of the land. However, the Treasury Department, which is part of the executive branch, has said that they are going to exercise discretion and not enforce the rules. So the question is, if you haven't already filed your report, do you need to? Well, as of right now, if you fail to file the report, it sounds like there's not going to be any penalty for failing to do so. However, that could be challenged. It's unclear whether or not the Treasury actually has the authority to just choose not to enforce this law. We've talked about this before on the show. Article 2 of the Constitution says that the executive branch has to faithfully execute the laws passed by Congress. So the Treasury Department, in theory, can't just say we're not going to enforce this rule. There's probably going to be a lawsuit brought against this. We'll see what the Supreme Court decides. And keep in mind, too, even if this is allowed to stand, even if the current Treasury Department says we're not going to enforce it, that's all fine and dandy. Several years from now, a new administration comes in and puts a new person in charge of the Treasury Department, and they decide they are going to start enforcing the law. So as of right now, the law is still on the books. Even if the Treasury Department decides to temporarily not enforce it, that can always change when a new administration comes in and changes policy. So without an act of Congress actually repealing or changing this law, it is still the law of the land, so it's something you guys need to be aware of. I'm not an attorney, I'm not a CPA, I'm not going to advise you whether or not you should or should not file the BOI reports. I actually filed mine, last year, just to get it over with before the injunction got put back in effect. But I will leave that up to you, and please consult with your attorney before deciding what to do. So a couple weeks ago, we talked about this ongoing lawsuit between REX, Real Estate Exchange, and Zillow. Originally, NAR, the National Association of Realtors, was listed as a defendant as well, but they've since been removed from the case, and now it's just REX against Zillow. And this was over Zillow's decision to implement NAR's optional no commingling policy. So this policy is optional at the national level. It's up to the local MLSs whether or not they want to adopt it. And about 70% of the MLSs across the country have chosen to implement the no commingling policy. So what that means is, if you're a website like Zillow and you receive an IDX feed and you're displaying these MLS listings on your website, if that MLS has the no commingling policy implemented, you cannot display the MLS listings alongside or next to or commingled with non-MLS listings. And you have a company like REX, a brokerage that is not a member of NAR or any NAR-affiliated MLS. Basically what this means is if you go to Zillow or any other website, you are going to see REX's listings relegated to some other page because they can't be displayed alongside the MLS listings in that market. So like I mentioned, NAR has been removed from the lawsuit and Zillow is the only remaining defendant, which is interesting because Zillow has actually been rather outspoken about this for the last several years. Zillow would love to see the no commingling policy go away because if you think about it from Zillow's perspective, it makes the website less user-friendly. Zillow would love to be able to commingle and display all of the listings, whether they're MLS or non-MLS, together in one feed. That would just provide a better experience for the customer. However, if Zillow did that, if they violated the no commingling policy, they would lose access to all of the listings from the 70% of the MLSs across the country that have adopted this optional no commingling policy. So a jury did find in favor of Zillow back in 2023, but REX was seeking to appeal that ruling, and the DOJ recently got involved and made some arguments in front of the United Circuit Court of Appeals in Rex's favor. Now, this is according to RIS Media. Quote, the Ninth Circuit Court of Appeals yesterday affirmed a lower court decision denying listing service startup Rex's attempt to revive claims that Zillow and the National Association of Realtors conspired to implement the no commingling policy in violation of antitrust statutes, as the long-running lawsuit appears to have finally fizzled. In a 6-page ruling, Judges Sidney Thomas, Daniel Bress, and Anna DeAlba wrote that Rex, a Texas-based discount brokerage that originally sued NAR and Zillow back in 2021, had failed any concerted action by defendants and also could not retroactively allege a conspiracy between individual MLSs and Zillow. Each NAR-affiliated multiple listing service independently chose whether to adopt the rule, and indeed 29% of them did not. The rule was in fact optional and does not establish an antitrust agreement by itself, the 3-judge panel wrote. The ruling comes swiftly after oral arguments, which notably drew participation from the Department of Justice Antitrust Division. On February 13th, a lawyer for the DOJ had explicitly argued that optional rules created or enforced by NAR or MLSs could be mandatory in nature. That clearly did not convince the Ninth Circuit, whose decision is likely to represent the end of the claims by Rex, which has argued that the no commingling rule was a way to ensure non-MLS companies could never compete with realtor-controlled MLS listings. In a statement provided to RIS Media, a NAR spokesperson called the lawsuit meritless and said the organization was ready to put the long-running controversy in the rearview. In affirming the decision of the district court, the appeals court emphasized what we've said from day one. NAR's no commingling rule never constituted an antitrust violation. The rule is optional, leaving MLSs the choice of whether to adopt it, the spokesperson said, unquote. All right, shifting gears, the HUD Secretary, Scott Turner, has vowed to take steps to cut regulation and boost housing supply. This is according to RIS Media. Quote, in one of his first official speaking engagements after being sworn in as HUD Secretary earlier this month, Turner addressed the National Association of Home Builders Leadership Council, which met in Las Vegas in conjunction with the 2025 International Builders Show. Turner pledged to work with home builders and all interested stakeholders to find long-term solutions that make homes more affordable, spur business creation, and create economic opportunities for all Americans. It's time we unleash the power of the private sector and the free market to build our way out of the housing affordability crisis, said Turner. We're going back to the drawing board to restore efficiency at HUD. The HUD secretary further emphasized that as part of this process, the foundation of a stable fiscal house is regulatory reform. At HUD, we are taking inventory and terminating all cumbersome regulations that make it harder for individuals and families to realize the American dream of homeownership, unquote. So it's worth noting that builder confidence has been edging lower lately due to uncertainty on Trump's tariff policy. Scott Turner has made a lot of comments about this, how he wants to cut regulation, become more efficient, promote the private sector, boost housing supply. But it's time for the rubber to meet the road. So we're about 6 weeks into this new administration. It's time for HUD to start making good on some of these promises. Hopefully Turner will be able to deliver, and it's not just all talk. So we will certainly keep an eye on the emerging policies from HUD and keep you guys informed about what they actually do rather than what they just say. So speaking of tariffs, this is according to Housing Wire. Quote, the Trump administration announced Wednesday that it's granting a 1-month tariff exemption for automobiles from those two countries. That, of course, is speaking about Canada and Mexico. The move came in consultation with the big three auto dealers. It's unclear if the pause comes with concessions from Canada and Mexico. The move has been telegraphed since the 25% Canadian and Mexican tariffs took effect on Tuesday. U.S. Secretary of Commerce Howard Lutnick said on Bloomberg TV that a compromise between the two nations is possible, giving a vague potential outcome that the tariffs could meet somewhere in the middle. In potentially bigger news, Trump also said that so-called reciprocal tariffs will take effect on April 2nd. That would impose a duty on all imports that matches the percentage that other countries have on American goods. It has the potential to reset the price structure on a substantial portion of the economy. Rather than tying the tariffs to change in trade policy, the duties on those countries are intended to force commitments from Canada and Mexico to curb the flow of fentanyl into the United States. When President Donald Trump announced the pause on Canadian and Mexican tariffs at the beginning of February, it came in exchange for military deployments to their respective borders with the purpose of combating illegal immigration and drug trafficking. The auto exemption has homebuilders feeling left out. The National Association of Home Builders previously made a plea to the administration to exempt building materials from China, Mexico, and Canada. Home builders heavily rely on exports from those countries, particularly for hardware, appliances, and lumber. Rather than getting an exemption, Trump has threatened to put a tariff on Canadian lumber exports, floating that it's potentially a national security threat. He also said Tuesday that he would impose a 25% duty on steel and aluminum imports on March 12th. If the country-specific tariffs stick and he adds duties on lumber and steel, it would cause a substantial rise in the cost of building a home. A report from John Burns Real Estate Consulting concluded that tariffs would not only increase construction costs, but also likely raise borrowing costs. Builders have warned that tariffs impacting construction materials would contradict a memo that Trump signed at the beginning of his second term that called for emergency relief in home prices, unquote. So in Trump's recent address to the joint session of Congress, he discussed tariffs more in terms of parity with other countries. So the term reciprocal tariffs is what he said. And he kind of explained that, hey, there are countries out there that are charging us higher rates than we're charging them. So, for example, if a country is charging us a 25% tariff, we should charge them a 25% tariff. If a country is charging us 10%, we should charge them 10%, and so on. So my personal opinion on tariffs is that you need to be really, really careful with tariffs. If the purpose of the tariffs is more of this reciprocal nature where you're just trying to use it as leverage to get other countries to lower their tariffs on us, that way both countries have lower tariffs and free trade grows rather than shrinks, or if you're using the tariff to negotiate a specific concession that you're trying to extract, like has been done in the past with Canada, Mexico, and China, or if you're doing it to reshore manufacturing of specific things that are really paramount to national security interest, then I think in those situations, tariffs can make sense. However, Trump is kind of back and forth on this. In certain circumstances, he's used tariffs as leverage to negotiate specific concessions from countries, and then as soon as that country complies, the tariffs go away. However, he also tends to talk about tariffs as if they are a good thing in and of themselves, and that enacting tariffs would somehow result in improved wealth and prosperity for the American people. But the historical evidence doesn't really support that. Comparative advantage, free trade, these are all things that have helped American households become more wealthy over time. It has been a boon to economic growth in America. So it's true that tariffs can provide positive outcomes for certain people, but they tend to produce more negative outcomes across the board. So let's talk about a recent example of this. So you may have heard that Honda has announced they're going to start building the Honda Civic at a new plant they're going to build in Indiana rather than in Mexico. Now, this is according to Reuters. Quote, Honda has decided to produce its next generation Civic hybrid in the U.S., state of Indiana, instead of Mexico, to avoid potential tariffs on one of its top-selling car models, according to 3 people familiar with the matter. The change underscores how manufacturers are scrambling to adapt to U.S. President Donald Trump's proposed 25% tariffs on goods from Mexico and Canada. While several automakers have expressed concerns about the levies, Honda's move is the first concrete measure by a major Japanese car company. So the question is this a good thing? Reshoring of manufacturing jobs into the United States tends to get very positive headlines. It's looked at as a very positive thing. And in fact, it is a great thing for the people who are going to be getting those jobs at that plant in Indiana. It's great for them. It's great for the people in their community and probably some of the surrounding communities as well. When you see an employer open a plant and there's a bunch of jobs created in that local community, there's a bit of an economic ripple effect. So it's great for those people. However, when you manufacture the car in the United States instead of in Mexico, that is going to be more expensive and it's going to result in a higher cost for Honda Civics. So while this news is great for people in that section of Indiana, specifically for the people who are going to be actually getting those jobs, it's going to be slightly negative for anyone else anywhere in the country who plans to buy a Honda Civic because it's going to result in a higher price for the car. All right, let's wrap up today with the most recent labor market data. So on Thursday, we got the initial weekly jobless claims, and then on Friday, we got the numbers of new jobs being created and the updated unemployment rate. Now, this is according to Reuters on Thursday. Quote, the number of Americans filing new applications for unemployment benefits fell more than expected last week, suggesting that the labor market remained stable in February, though turbulence lies ahead from tariffs on imports and deep government spending cuts. Weekly jobless claims fell by 21,000 to 221,000, unquote. And then according to Yahoo Finance on Friday, quote, U.S. non-farm payrolls add 151,000 jobs last month, slightly less than the 160,000 expected by economists, while the unemployment rate ticked up from 4 to 4.1%, unquote. So the initial weekly jobless claims numbers were better than expected, but the number of new jobs being created was slightly weaker than expected. The unemployment rate ticked up slightly, so it's a bit of a mixed bag. Now, the unemployment rate had just dropped down to 4% in January, and that was after 7 months of the unemployment rate bouncing up and down between 4.1 and 4.2%. We finally got back down to 4% in January, and then in February bounced back up to 4.1%. Now, that's not really that big of a deal. Markets shouldn't have that big of a reaction over that. Like I said, we were in that 4.1 to 4.2% range for 7 months, got back down to 4%, now we're back up to 4.1. So not a lot of movement there. Jobless claims are still a lot lower than they've been historically in the last several business cycles. We've talked about this before. Initial weekly jobless claims have a lot of room to grow before it's cause for alarm. Typically what we see is initial weekly jobless claims in excess of 350,000 before we enter into a recession. And right now we're sitting at about 221,000. All right, y'all, that's a wrap for the show today. Just a reminder, you can find the show notes with the links to all the articles we covered today at realestatebackstage.com/episode 21. And I'll see you here next week with another behind the scenes look at the real estate industry here on Real Estate Backstage.